Hello, everyone. I want to welcome you guys to our webinar today on surviving in a tough economy. My name is Robert Coker. I'm a partner in the Birmingham office, and I will be your moderator today. I hope you've all had your coffee. Next. Today, we will be offering CPE for all attendees. However, there is one caveat. In order to receive the CPE credits, you've got to answer 80% of the poll questions to get this credit. We'll mail out those or email out those after the webinar, as it states there. You don't have to get the question right. You merely have to answer 80% of them. If you do have questions, certainly post those over in the right where you see the questions, and we'll do our best to either have time to answer those, and if we aren't able to do that, we will get back with you guys on that, or you can speak to one of our other CPAs or your advisor. Our CRI presenters today are Bobby Hayes. She's out of Albuquerque office. She is one of my esteemed colleagues, and I think she possesses quite the credential resume here. Our next one is Larry May, who is out of the Jackson, Mississippi office, and he too possesses many years of experience and qualifications in that regard. I'm going to go over today's agenda. We are going to cover these 8 items. We're going to do our best to finish that up by, say, 50 minutes into the presentation, so we do have time to answer questions. One is 2021 economic outlook for construction, PPP Loan Program, retention credit, protect your cash, watch your job costs, make sound economic decisions, maximize your bonding capacity, and plan for downsizing. With that, I'm going to let Larry take it away.
So we're going to first talk about and this is Bobby, so we're going to first talk about the 2021 economic outlook for construction. It's been a checkered environment for the construction industry. There are some pockets that have done really well in the last year, but in a lot of areas of the country, construction is down, construction labor is down, job sites have closed, there have been shortages in state and local government funding, and the office space market is also showing real signs of potential decline for the commercial industry. We project more rocks ahead in 2021. So the Architectural Billings Index is one of the best leading indicators for what's going to happen in commercial construction activity. And architecture firm billings declined for the 9th month in a row as of November. The Associated Builders and Contractors Construction Backlog Indicator was at 7.3 months in December, which is a decrease of 1.5 months of average backlog year over year. There's been a little bit of an improvement, though, in the Construction Confidence Index overall. According to Associated General Contractors, 13 of 16 sectors of the construction industry are expected to shrink in 2021. Not unexpectedly, retail and lodging are going to expected to take a pretty big hit. In construction, also private office is supposed to projected to be down quite a bit. Public works down, including bridge highway, and this is associated with the struggle state and local governments are having with their funding and their budgets. A couple areas that are looking up are warehouse and other healthcare, alternative healthcare, which may also mean expansion of non-traditional delivery of medical advice, telemed, etc. According to Associated General Contractors, 44% of contractors reported that projects were canceled in 2020 that have not been rescheduled. Also, 18% of companies reported that projects that were scheduled to start between January and June of 2021 have already been delayed. One of the strongest impacts are shortages and the increases of pricing that's happening with that. So for example, lumber has had a year-over-year increase of 36%, copper 20%, iron and steel scrap 40%. Contractors are still struggling to find skilled labor. There are a couple bright spots in the economy: multifamily residential projects, and home builders and remodelers.
And with that, we come to our first polling question. Which are the two major construction categories expected to experience the highest decrease in 2021? We're going to give you guys a minute or so to answer that, and I'll give you a warning near the end when we're about to close the poll. Remember, you need to answer 80% of these to get your CPE credit. I guess, do we have anything to add in the interim, Larry or Bobby, on any of the points that we made earlier?
You know, I just want to add another comment that construction overall contributes about 4% to gross domestic product in the U.S., so it's a pretty big sector of the economy, and that sector hurting is an example of the challenges the underlying economy is facing in 2021.
Yeah, I think Bobby covered it very well. I think there's certainly some challenges, but I do think that the construction industry overall is strong, and hopefully will, by the end of this year, we'll start seeing a lot more projects going on.
We're seeing a pretty good decrease in backlog in terms of that. They're working through those now in our sector, and hopefully that will continue, but we'll just have to wait and see.
Yeah,
okay.
And there's also.
Go ahead, Bobby.
I was going to say there's also the possibility of an infrastructure bill coming out of Congress. Even if that comes out, as we know from past projects of that type, it takes a few months for that to actually get to where people are putting shovels in the ground.
Sure. Okay, I'm about to close the polling questions. Okay.
Okay.
And the answer to that is, Larry, or Bobby, rather?
Retail and lodging.
Not shocking.
Let's talk a little bit now about the PPP Loan Program. So the first round of the PPP program last year generated a little over 5 million loans, about 500 billion in loan funds went out. So of those, about 450,000 loans, about 9% of the actual loans and about 11% of the relief went to funding to construct companies in the construction industry. So a lot of companies waited to apply for forgiveness because of the uncertainty of what was going on with income tax implications. Kind of had a little war going on there between the IRS and Congress till Congress made its intent perfectly clear in the bill that was passed at the end of the year. And also, people were waiting for simpler processes. So now we know what the income tax implications are. We know that the loan forgiveness is not going to be taxable income, and the expenses that are used to support forgiveness are going to remain deductible. In addition, for financial statements, if forgiveness is likely, even if you haven't applied for it, the loan is going to be reported as grant income on your financial statements for the 2020 fiscal year. Right now, SBA has already issued simpler forms and processes in response to what was passed in the Economic Aid Act. Now, there's still another first round of a PPP loan if you didn't get it in 2020. I want to bring that up in the new bill. There are companies that didn't get a PPP loan in 2020 that are rethinking their position on getting one, and so those are available. There is also a second draw round of PPP loans available if a business has previously received a PPP loan and used up the proceeds. There's an economic restriction on applying for a second loan. There's no economic restrictions on applying for a first loan. The economic restriction for the second loan is needing to be able to show a drop of 25% in gross receipts between comparative quarters of 2020 to 2019, example, first quarter 2019 to first quarter 2020, or an overall drop of 25% based on your 2020 tax return being filed. A lot of banks are wanting companies to have the first loan forgiven or be in the process of forgiveness before they apply for the second round.
And with that, we come to our second polling question, and I'm going to launch that. What is the income tax impact of PPP loan forgiveness? And while we're waiting to answer that, I think one thing to note also, there are also, for those who didn't get a PPP loan at all, they are allowing you to go back and actually apply for the original PPP loan under those same guidelines described, and they're not as strict as the second guideline. Anything
Correct.
else, Bobby?
I'd like to point out that if you are applying or considering that first round PPP loan, you can use 2019 payroll figures or 2020 payroll figures.
Good point.
Bobby, one thing I'd like to point out that you and I've talked about is that, you know, based on your tax method, even though your internal financials or your financial statements do not look like you could qualify for the second round, based on your tax return, if you're a completed contract or cash or something like that, you still could qualify for that. So it needs to be looked at.
Yeah, I would say consider different approaches.
Okay, I'm about to close the second polling question. I'll give you a few seconds there. Looks like about 79% of you have voted. Going once, going twice. Okay. And the answer to that polling question, Bobby, is?
That the forgiveness is not taxable and all of the expenses used for forgiveness remain fully deductible for tax purposes. I'm going to talk about one last piece in this economic section, and this is the retention credit. A lot of companies really didn't know about the retention credit. Larry, can you move to the next slide? Yeah, great. So the retention credit was passed in the original CARES Act. So what happened in the original act is that you were not allowed to use the retention credit if you also got a PPP loan. So most people never learned about it because most companies got a PPP loan. But the restriction was retroactively removed for 2020 and the credit was extended to June 30, 2021. Now there's two ways to look at getting the retention credit. So first of all, the retention credit for 2020 is a refundable tax credit of 50% of eligible wages up to $10,000 per employee for calendar 2020. It will increase for 2021 to be 70% of eligible wages up to $10,000 per employee per quarter in 2021. So the maximum credit's $5,000 for an employee in 2020 and potentially $14,000 for an employee in 2021. And this is applied for on your Form 941. So it can only be used for wages that were not used for forgiveness in the PPP loan program. So the buckets of credits and wages used for forgiveness all have to be kept mutually excluded. Now, there are restrictions in place on using the retention credit. You have to qualify one of two ways. The first way is about a drop in gross receipts. And for 2020, the drop in gross receipts is quarter to quarter, first quarter 2019, first quarter 2020, for example, of 50% or more in gross receipts. If you do meet that, then you get to use the credit for the whole quarter, and you get to continue to use it until the quarter after you recover to at least 80%, quarter over quarter of gross receipts. It's a lower bar in 2021. We are looking at meeting a criteria of 20% drop or more in gross receipts for comparative quarters 2019 to 2020. So for the other way to qualify, if you don't have that drop in gross receipts, is for a period of full or partial suspension of business due to a government order. So non-essential businesses mainly were considered to be things like retail, restaurants, bars, any of those that had a period of full or partial suspension of business due to one of the government orders with COVID that limited commerce and travel are eligible to use the retention credit for the total or partial suspension of business period. If you qualify by receipts, you get the whole quarter. If you qualify by total or partial suspension, it is for the period of that suspension. Now, for an essential business, and construction was mainly considered an essential business for most of the states, not all, but for most of the states, an essential business can have a partial suspension based on facts and circumstances. And the facts and circumstances have to support a case where the partial suspension had more than a nominal impact on business operations. Now, nominal means very small. So it's a little bit in the eye of the beholder about making the case and what could support a more than nominal impact on a business operation. So for an example, you couldn't operate because suppliers were unable to make deliveries of critical goods or materials, or job shutdowns may have had an impact on business operations. So one of the things to think about with the retention credit is if you think you're going to qualify, for example, for that 20% decrease quarter over quarter, you may want to think about that as possibly having higher value to your company than getting a second PPP loan, or you may not qualify for a second PPP loan because you didn't have that 25% drop. But if you have a 20% drop quarter over quarter, looking in your 2021, and you can compare that quarter to 2019 or 2020, you would be eligible for the full quarter. Now, there is another restriction, and that's on full-time equivalents. So employers with an average of more than 100 FTEs for 2020, the qualified wages are wages paid for time an employee is not providing services. But if your company has an average of less than 100 FTEs, all qualified wages are eligible except for owners and related parties. For 2021, that 100 employee bar is lifted to 500 FTEs. Now, a full-time equivalent is considered for this credit to be 30 hours a week. Now, that does not make somebody that worked 40 hours a week 1 1/3 employees. It's just you quit counting at 30 hours a week for an employee, and then, ones that work just 30 would still qualify as a full-time equivalent. One that worked 40 would still count as just one full-time equivalent.
Okay, with that, I'm going to launch the third polling question. What disqualifies a business to be able to use the retention credit? I guess while we're waiting on you guys to answer that, Bobby, one of the things you said was the mechanism by which you obtain this retention credit is via the 941. If you've already filed the 941s, what's the best mechanism? Do we amend, or what do we do on that?
Okay, so if you go back and you're looking at 2020, they did pass a provision in the bill at the end of the year that you can file for all of 2020 on the quarter in which the bill was passed, which was the December quarter, which means you can file for the entire year of retention credit on the fourth quarter 941, or amend the fourth quarter 941 if you have already filed it.
Fantastic. One other quick question is, how long is the shutdown have to occur to qualify? You were mentioning that earlier.
I think you're going to have to look at impact potentially on billings. One of the things that we've been looking at is relating what the missed billings are, because a company couldn't bill on a particular job for shutdown. What was the impact on prior months or quarters of billings on that job? So we can have something to assess maybe what the impact is for a period of time that was suspended and they could not bill for that job. And we've seen jobs that were postponed all the way, started up again, shut down again, jobs that would have been finished in 2020 that now are being finished in 2021. There's various ways to look at it.
Okay. Okay, I'm about to close the polling question. It looks like we've got about 75% of you that have voted. Going once, going twice. Okay. Give us the answer to that one, Bobby.
The answer about disqualifying is having an increase in gross receipts and being able to stay open all the time.
Okay. At this time, we're going to introduce Larry May, and he's going to take it from here.
Thanks, Robert. Yeah, we're going to start with talking about protecting your cash. I mean, one of the most important things to remember, you always hear in construction that cash is king. So maintaining a strong cash position is extremely important to help you survive an economic downturn and a diminishing backlog. So one thing that you would like to do is you always want to bill as aggressively as your contract allows. I don't think any contractor has a problem with that, but in an economic downturn, you certainly want to make sure that that's going on. And keep in mind that one of the main reasons to protect your cash is most contractors are overbilled. So you're ahead on your project. You're going to have to use that cash to pay to complete your projects. The second thing is to follow up on your outstanding invoices often. The squeaky wheel is going to get the grease. And so, working your receivables and working them often are extremely important to make sure that your collections are coming in a timely way to support your project. You don't want to use your own money to finance your project. You, of course, want to use your clients. Honor the pay when paid clause to your subcontractors and your suppliers. I know a lot of my best contractors, they don't like to do this because they have a really good relationship with their subcontractors and suppliers, and they tend to want to pay in a timely manner. But as things slow down and your backlog is being dwindling and contracts are being delayed, contracts are being canceled, it's very important to honor this so that you don't end up paying for things that you don't get paid for. The fourth thing is delay your non-essential replacement of equipment and vehicles. A lot of times the yellow equipment salesmen, they're always calling you. They've got the latest and greatest, and they're really pushing to replace, and the equipment's going to do so much better. But in a downturn, it's often very, very important to just delay this if it's not an immediate need, if what you have is getting you through. Delay non-essential sell your idle equipment. The other thing, a lot of times contractors view idle equipment that's paid for as not costing them anything, not thinking about the insurance cost, the taxes cost, and the repairs and maintenance on that equipment. If you have equipment that's idle and you don't see using it in a very short period of time or any time in the near future, go ahead and get rid of it, sell it, and get that money, bring that money back into your business. And this is something really that applies always, but particularly in a downturn, is don't be paying for personal items through the business. RVs, boats, hunting camps, fishing cabins, farms, land, all that stuff is wonderful to have, but you don't want the business to have to support that when you're in a down economy. So it's best not to buy, even in a good economy, buy that stuff personally and keep it out of your business. Even if your cash position is strong, right now interest rates are really low. So it's important to finance your equipment and vehicle purchases with long-term debt and 4 or 5 years. Even if you can come back later and you choose to pay it off, it's still right now to maintain your cash and to have it there as a safety net. It's important to do that, knowing that, you know, better things are to come. Everything runs in cycles, but right now interest rates are low. If you need new things, finance those and don't go through your cash. Anything that you can prepay, a lot of times it's easier to pay things annually, but if you can pay things monthly without a lot of cost, always just do those monthly, move them to a monthly position instead of paying them out annually. Prepaid expenses really doesn't do your business any good. So it's important to do those things. Eliminate idle workers. No one likes to do layoffs. It's a very unpleasant thing. People care about their workers and their family. But if you don't have anything to do for people to do, don't hold on to them too long. Right now, you don't want to use that money to support people when they're not actually making you money. A lot of companies have bonus incentives that are built in to their workers agreements, but you know, it's always good to, you know, number one, you need to reduce or suspend those for a while until we see how long it'll take things to pick back up, particularly if your business is starting to see a lot of delayed or canceled contracts. You want to be sure to preserve the business and either, you know, tell your employees that, you know, that they'll be coming when you can or if you can. Reduce and eliminate non-essential travel. A lot of businesses that really, when the downturn first started, thought that they were going to have a lot worse effect once they actually hit a slowdown than they did, because a lot of non-essential travel was suspended because either you couldn't go anywhere or you chose not to for your health or your safety, which has been a tremendous savings to a lot of businesses. So that's definitely something you want to continue to do as we weather this economic turn down. And then, you know, anytime you have a downturn in the economy, it's always wise to review your overhead for any items that can be eliminated and reduced. In the good times when everybody's flush with cash and they're busy, things just creep in and add to your overhead. That people get more generous with gas cards, with truck allowances, with whatever. And those things do nothing but add to your overhead cost, that this is a good time to look at it again and maybe implement some new policies and reduce those things. One thing that is not overhead, if you have a lean accounting staff that's doing a good job, don't think of them as overhead, because, you know, what is essential also in a downturn is to know where you stand on your jobs, where you stand in your company, on your company's financials. So that is often looked at, the accounting staff is often looked at as overhead, when honestly they really are a key component to you keeping your business going. Now, if you have a bad worker, that's a different story, but in most situations, I would say that that's not necessarily considered overhead. So we come to our next poll question.
And with that, I'm going to launch the fourth polling question. Which of the following helps a company protect their cash? And I guess while we're waiting on that, Bobby, do you have anything to add, or Larry?
No, I don't have anything at this time.
You know, one of the other things you can consider in all this, you can have some cash savings from just the tax savings themselves. So sometimes it's wise to look at that as a potential way to preserve cash. I'm not just doing it.
Yeah, tax planning's timing. It's always timing. And you're right about that, Robert.
Absolutely. And I think one thing that's really helped a tremendous amount is most all of my clients did apply for and receive the PPP loans, which have been, you know, a great infusion of cash in a tough time. So I think those things will certainly help, as well as now that they've changed the rules about the retention credit to also help contractors hold on to their cash. So there's some good stuff out there to help weather this storm that I think makes it more positive than the downturn of 2008, 2009.
Well, I also think too that when the first round of PPP loans went out, there was this push to have to spend all the money in 8 weeks. So there's a lot of bonusing and everything like that going on to try to spend the money to show that you could use it. Now that we know we have a 24-week period, I think that pressure's off. If you get a second round loan, watch your cash.
Okay, I'm about to close the fourth polling question. Looks like 81% of you have voted. Seems like we're going up. With that, I am going to close the polling question. And give us that answer, if you will, Larry.
Yeah, that's all of the above. I mean, you want to bill aggressively, finance equipment and vehicles, and continue to follow up on outstanding receivables. So the next thing we're going to talk about is watching your job cost. You know, job costs often increase when you have fewer contracts in progress. It's just the nature of the beast. So often the reasons are multiple, but a lot of times the labor force will know that there's a slowdown of work occurring. And of course, what are they going to do? They're going to become less efficient due to the fear that you will have to have workforce reductions. So, you know, watch your labor force. Also, if you have a lot, you know, some people where you don't want to reduce your workforce, you may just actually send more people to the job, but it doesn't necessarily mean that your job will get ahead of schedule. So you end up with more job costs on your contracts. Delays in material due to shortages are occurring, which can also delay the completion of your project. If you can't get your stuff in to do the work, then of course you're going to get off schedule there. So, you know, please, you know, ensure that you're placing all your orders timely and following up on the delivery, because you do not want material shortages to get you off schedule, because the longer you are on a job, the more costs you're going to incur on it. In addition, material shortages lead to increased costs. So, you know, as Bobby was pointing out on various material components that have gone up, steel, plywood, copper, all those things, you know, one thing you may want to look at is if you don't have a clause in the contract that allows for change if prices go up, you may want to look at the alternatives that will comply with the contract as well as the design of your project. So you may want to meet with your architects or your owners to say, hey, what if instead of using, you know, steel, we used aluminum or whatever that might be, to try to keep your cost under control, and as you bid it, to protect your profit margin. The one thing, you know, to also consider is the fewer jobs you have in progress, the more indirect and overhead costs are going to get allocated to those jobs. So you may end up with a lot more than you included in the bid, reducing your overall job profitability, because if you have a shop and mechanics and things like that, if you had, you know, generally had 10 jobs worth 20 million in progress, and now you only have, you know, 7 jobs and 15 million in progress, the jobs that you have are going to have to bear the brunt of those costs, in addition to your overhead allocation and other things. So just by the nature of having fewer jobs open, they're going to naturally incur more cost. So that's another reason to look at reductions in any of your indirect costs that you can, your overhead costs, so that you don't get off budget for your when you're tracking your jobs simply because you have fewer things in progress. And I think you can never underestimate embracing technology to increase efficiency and reduce rework. There are a lot of different things out there that are coming out more and more. There's more and more coming out all the time that are helping contractors be more efficient. I can remember when the GPS systems were put on the yellow equipment so that you can cut a grade exactly the way it is without stopping and measuring and all that. I know with self-driving equipment and other things like that, you know, don't put off technology. I know it kind of goes against the grain because some of it is very expensive to implement it when you're in a downturn, but if it's going to save you more than it's going to cost you, you don't want to be left behind. You know, embracing technology is important in any industry, including the construction industry. So the next thing we're going to talk about is making sound economic decisions. And, you know, anytime there's a big change, there always becomes fear in the marketplace. And right now we're in the middle of a slowdown in construction. We have an overall economic slowdown due to the hospitality industry has been gutted. The different components Bobby talked about. There's too much office space out there. We're in the middle of a COVID-19 pandemic. We just had a very divisive election and a change of administrations. All of these things make people fearful, and often fear makes you do things that are not sound economic decisions. The number one on my list that I try to talk to my clients about all the time is don't ever try to buy work to keep your cash flow going or just to keep your workforce busy and hold on to them. As we all know, anything that can go wrong usually does go wrong. So as careful as you can be when bidding a project, you may think if I just bid it for cost to make sure you win it, that you'll still do okay because you'll cover your costs even if you don't make a profit. But just as we've talked about with material prices increasing, things happen that are beyond your control. And in a best case scenario, I see profit fades very, very frequently in all of my clients. So you do not want to buy work, because what you end up doing is you end up paying your client to build their project. And certain overruns can occur that can be catastrophic. I've seen many businesses fail by one bad job. So you definitely, that's the main one that I can't emphasize enough, is that's never a step you want to take as a contractor, because you always need to try to bid the job to cover not just your costs, but to include some profit. We've already talked about this some, but every business is made to make a profit at a certain volume. So if your business is built that you need $10 million in volume to make a profit or to break even, then when you go through an economic downturn, it's a good time to look not just at your overhead, but your indirect costs, which includes your equipment fleet, shop cost, all of those things, to look at them and see, is there a way I can cut this cost and so that I can be profitable with a lower volume? Or if I can, there's always more bidders in the market. So if the bid market has driven your average gross profit from 5% down to 1%, how can I be profitable and still compete in the marketplace? So it's a great time to look at those things, to reposition your business to be profitable even in a downturn. Because then if things turn around and you've made it where you can be profitable at 8 million, if you get 20 million, you're throwing that much more to the bottom line and you're going to be that much more profitable. The market, I know a lot of things. I'm involved in Associated Builders and Contractors, both in Mississippi and nationally, and a lot of things people always get scared in the not-for-profit world, as well as in their own businesses, trying to anticipate the stock market. So if you have investments in your business, don't liquidate them because an administration is about to change. Don't liquidate them because there's been a bad month in the market, a bad week in the market, a bad day in the market. Historically, the stock market is always going to bounce back. With that said, it's also not best to have a lot of equity investments in a contractor, because in a downturn, a lot of times, your surety company is going to discount those more than they would in a normal market. But if you do have them, hang in there, because with every day that the stock market drops, it comes back, and historically it always bounces back. So don't let fear make you try to be a predictor of the investment markets. Don't spend $1 to create a tax deduction for 30 cents. I don't know a contractor or any other person that loves to pay taxes. However, at the same time, it's better to pay your taxes and keep 70 cents in your business than it is to buy something you don't need simply to create a tax deduction, or to do something you don't need to do for a tax deduction. Apply this logic when you're thinking about vehicles and equipment or bonuses, particularly non-essential, non-owner bonuses, to your business development items such as hunt trips or going fishing, or taking a group traveling, or going to the Super Bowl, or whatever it might be that everyone loves to do. And you try to think of it as a business development expense, but that's not really a good use of your cash and your money. So that's not a wise economic decision. Even if you were able to take all of those items as a tax deduction, which you no longer can, they're still not worth spending $1 for that 30 cents. Don't invest company money in real estate, because if you do, real estate is not something that turns around quickly. It's kind of like one of the problems with estates that have a lot of land is to pay your estate tax. If you were subject to it, you would have to liquidate it, which is why, in years past, when the estate tax was much lower, many families lost their family farms because, they were having to sell their land for hardly anything simply to try to get the money to pay their taxes. It's hard to liquidate real estate very timely. Now, that would depend on where you are. Nashville's hopping right now, and there are certain areas, but if it's rural Mississippi or rural Alabama, that's a different story, and that's usually where hunting camps and things like that are located. And once again, embrace technology. I mean, that is a very wise economic decision to try to stay not just current, but even getting ahead of your peers. The more things that come around that you can do and embrace, and there's so many things coming out for construction, from things to help with safety, timekeeping, project management, doing the you're using drones to go through and look at where you are on things. So, definitely embrace technology. So the next thing we have coming up is we have another polling question.
And sorry, I was quick on the trigger there, Larry. Anyway, we are going to launch our fifth one. Contractors who buy a contract are more likely to blank. And while we're waiting on that, I guess one of the things I would add on making good business decisions, we're fully aware of how difficult it is to have really good skilled labor force. So one of the options that might even be considered, if you do see that there is going to be a reduced backlog, you might even consider maybe pay cuts rather than having to lay the employees off. And I think that's an option as well. And obviously, if you get into the cycle and find you have the ability to pay that back, well, you do so, right? But I think everyone would agree that it's just very difficult to find skilled labor.
Yeah, absolutely, Robert. I think that's a good point. Another thing is, during hunting season, a lot of times employees don't mind taking some unpaid leave or something like that.
Well, I can tell you firsthand, I had a grandfather in construction as well as my great uncle, and they would do that because it was during the rainy season and they would be doing highway work, and that's not necessarily conducive for the big yellow equipment to be operating, and they loved to hunt. And so did I. So I got the bonus of that. I guess with that, I'm going to give you guys a few more seconds before I close the fifth polling question. Looks like 76% of you have voted. Going once, going twice. So, all right, Larry, give us that answer.
Yeah, so contractors who buy a contractor are more likely to end up paying their customer to construct the project, as we went over, and that's something you don't want to do. So now we're going to talk about maximizing your bonding capacity. I think this is very important during the slowdown because your competition increases. As larger contractors, they're a volume machine a lot of times, and so they drop down into smaller markets and they're competing. And so all of your stuff has all of your bid work is that got many more competitors that you didn't necessarily always have. So with what you want to do is you want to position yourself that where you're the one that can make that the surety is going to bond, even when other people maybe have made some decisions where they have filled up their bonding capacity. So you want to maximize yours. In addition, the surety market often tightens in a tough economy, so you want to be looking your best. And my good friend Dan Holliday and my mentor always said, your year-end financial statements are like picture day at school. That's when you want to look your best. So we always want to be looking at year-end prior to year-end so that we can make good decisions that can absolutely help with your bonding capacity. And I know we try to do that at our firm because, not just to minimize your taxes, but also to maximize your bonding whenever you're doing your year-end planning. So discounted working capital is what drives bonding capacity, and loosely working capital is your assets less your liabilities. Discounted working capital is where they often discount other things. I mentioned earlier, prepaid expenses do you no good because your bonding company is going to throw those out when they're calculating your working capital, even though on our financials we may have it in there. There's also other things that they throw out, deferred tax assets, things of that sort. But so your discounted working capital is what drives your bonding capacity. Depending on what your discounted working capital is, should bond you between 10 and 20 times, depending on how high that number is, your history with the surety, your character, and all of those things. So one thing to do to help maximize your bonding company capacity, once again, is work your receivables. Your bonding companies are often going to discount any receivables that are over 90 days old. And in the construction world, particularly if you're a subcontractor, we all know that often, it's easy to get things beyond that point. But, try to work those receivables and keep them coming in. Squeaky wheel gets the grease. Refinance your debt and stretch it out for a longer period of time. I know nobody likes debt. We think that that's not a good thing in business, but your debt can often be used to your advantage. But the key is if you have a balloon note coming due within a year of your calendar or fiscal year end, that's going to really hurt your working capital. So go ahead and take the opportunity before year end to refinance that out, so that a smaller portion will be coming out of your bonding capacity. Your working capital. Secure your debt with your equipment fleet or fixed assets or even personal assets of the owners, not CDs or receivables or any current assets, because then that debt becomes current itself, or the asset securing it becomes long-term. So you're losing your working capital for your CDs and your receivables. If you're into your line of credit at year end, as year end approaches, go ahead and refinance that into an installment note over a longer period of time, because usually lines of credit do not have over a year maturity, and sometimes they're not secured by a long-term asset. So that's something to go ahead and do. It seems like a no-brainer to write off payables that are not going to be paid, but a lot of contractors will leave those on there, even if there are back charges that are going to keep them from paying those bills to their subcontractors, or if it was faulty materials, to a supplier. So go ahead and keep your payables clean and written off. Don't leave them on there because of a potential income tax hit or something else. If you need to infuse cash into your company to increase your working capital, a lot of time one of the best things to do is borrow against your equipment fleet or any other your long-term assets, own a long-term installment note, and put that cash back in the company. And if you're an owner, you can loan money back to the company as long as your promissory note is due at over 1 year from the date of your year end. So I've known clients that needed to take bonuses for tax purposes at year end due to their tax method, but they would take the bonus and go ahead and run it through their W-2, but then they would loan it back to the company to make sure the company's picture looked as good as possible. And owner loans can be subordinated by the bonding company, or particularly if they're over 1 year on a promissory note, they're non-current anyway. So those are some items to help out your working capital. The next thing we're going to cover is plan for downsizing. Nobody likes to think about downsizing. I know, we even with employees that you don't think are doing their work, it's often you know them, you know their families. It's hard to get rid of them. But one mistake often made in a downturn is to keep idle employees, and as far as that goes, equipment, for too long. So go ahead and examine your equipment fleet and identify pieces that can be disposed of without affecting your productivity. You don't want to keep, things too long that aren't making you any money and are actually costing you money, even if they're paid for. Look at the pieces that need maintenance and repairs and take the advantage of a slowdown. If you need to you've been going nonstop in this past year because you were deemed essential, but your equipment and stuff has got some deferred maintenance on it. If you get a slowdown, go ahead and use that to put your equipment in tip-top shape so that when you have plenty of work going again, you're ready to go. Examine your workforce for a plan for a phased downsizing as your volume decreases. And what you want to do there is just look at your people and try to use a performance-based model, not the number of years of service to you, or who's a family member, or all that stuff. I know those things are tough, but what you want to do is you want to make sure that you're planning to keep your best people employed the longest. So those are the ones you want to hold on to. So you want to identify your key employees that would you like to keep, and determine which employees, and often any company's got 10% or more who could probably be reduced immediately with a minimal impact on the business. So go ahead and do that, because the longer you plan ahead and the better plan you get, the more you'll be able to weather a storm. And everybody hopes that you don't have to go through downsizing at all or multiple phases, but if you've got a plan, you want to make sure that you have planned for those multiple phases and you're doing it strategically to protect your business and to ensure that it's got a long going concern. So with that, we have our final poll question.
I'm going to launch this one. When considering workforce downsizing, it is best to blank. And while we're waiting on that, I guess, Bobby, do you have anything to add to that commentary that Larry just spoke about?
I do. I think that when you're looking at your employees, if you don't have anything to keep them busy, I think sometimes you have to face a situation where they need to be laid off for the time period if you don't have some kind of support, like a second PPP loan, et cetera, to keep them in place.
And I do think that's one thing, is to consider your FTE requirements for your PPP loan, but I would not let that be the overriding driver if I had some idle people, because even if you don't get the PPP loan forgiven, it's a 1% loan over 5 years, which is a really good deal any way you cut it.
One other thing to add, Larry mentioned it earlier about maybe getting rid of equipment. Being an economics geek, I understand the supply and demand curves. If you go ahead and do that now in a market where there's more demand and the supply is not as great, obviously your pricing on that would probably be better. So you can maximize the ability to convert those pieces of equipment to cash. Anything else? Okay. I'm getting ready to close the polling question. Going once, going twice. Looks like 80% of you have voted.
Yeah, and the correct answer to this, of course, is to develop a plan using a performance-based model, not seniority or other things. And so with that, I am ready for you, Robert.
Okay. We're going to actually have the opportunity for you guys to post any questions. I know that Bobby has really been doing a good job of answering a number of those. I don't know that everyone sees these, but that's certainly something we can go over. If we don't get a chance to address your specific questions, certainly reach out to Larry, Bobby, or myself, or your advisor in the local office that services you, and we'll be more than happy to get back with you on those questions.
There was one question that was posted that I think might be of general interest. I had to go look it up. If you're using a PEO, if you have leased employees, then you as the, in fact, employer are eligible for the retention credit. Your third-party payroll company will have to file that for you, but that is actually addressed by the IRS. They have a frequently asked questions area for the retention credit, and they answered it in frequently asked question 87. So you are allowed to still do it.
Looks like there were several great questions out there. Any other ones of note, Bobby, that you think might be nice to share with the audience?
I think several people wanted clarification on the PPP loan. If you get a second round PPP loan, you can still use the retention credit. You just can't use the same wages for both. If you were to get a second round PPP loan now and you qualify for the first quarter, you might not get the loan funded till February, and you would still have the month of January where those wages would be eligible for the retention credit, for example. And if you got a PPP loan last year, yes, you can go back and do the retention credit for last year. That's what they opened up in the bill at the end of the year.
Fantastic. Did you see any others, Larry?
I can't actually see the questions.
Okay. So I guess with that, I mean, we've answered a good number of those, and obviously we want to be respectful of everyone's time. Let's take care of a few housekeeping items. You know, we've got some upcoming events. Certainly we'd love to have you join us for those. We appreciate your time today. We've got these that are listed on the screen. Gone fishing. Obviously, this is a huge issue these days, and it's certainly a big, big risk. I see it all the time on the daily emails. It seems like I get some kind of cyber attack of some sort that's been reported. So we have to be really cautious during this time, because there's a lot of people out there that want to take advantage of this, and it can be very costly. And I think that's really going to be a great webinar coming up on the 3rd of February. Also, there's many ways in which you can connect with us, as you see here on the screen. I think we're all plugged into just about everything these days, especially in the remote environment. It seems like we're glued to the screen on a daily basis. So hopefully you guys can reach out to us and find other resources. And again, if we've not had the opportunity today to maybe address your questions, please reach out to us. You've got the handouts. You can download those. And again, we will be issuing CPE credits to those of you who answered 80% of these polling questions. And we certainly appreciate your time today. Thank you very much.